Hello everybody, welcome to the Northwest Quadrant Wealth Management E-News. Thank you for joining us. Well, the market drivers continue to remain the same, so we're going to talk a lot about what we've been talking about in the past. We have some new information, new data coming from the economy, which sort of reiterates what Josh and I have been thinking all along. First, that the Fed probably didn't need to be cutting interest rates as aggressively as they were last year, because there's a good chance that they might need to hike rates sometime in 2025. So this week we just got new inflation data, and inflation continues to go in the wrong direction, meaning inflation continues to run hotter than the Fed would like it. And we now have enough data that we know that pretty conclusively that inflation is headed in the wrong direction, and so the Fed doesn't look like to be cutting interest rates anytime soon. You couple that with the labor market report we got last week on the job market in the month of January. Unemployment dipped to 4.1%, so historically low unemployment. Wages increased by quite a bit, over 4% on a year-on-year basis, which is certainly inflationary, and so all the data continues to point to inflation moving in the wrong direction, which means higher interest rates, which stocks certainly were not anticipating. And it's why stocks have struggled to move higher in 2025 so far. It is also explaining why interest rates aren't budging. In fact, they've sort of drifted higher. So that will remain the story, I think, of 2025. The good news is on this front is that earnings are growing, and Josh can talk to the earnings situation.
One of the things that we were talking about in the back half of 2024 is how expensive on a valuation basis stocks have become, and of course that was okay as long as earnings growth ultimately materialized and supported those valuations. We're now about 80% of the way through earnings season, and earnings season has been actually nothing short of spectacular. Earnings growth's come in around 12% year on year, which is actually a little bit more than double expectations. The other theme that has really been noticeable and prevalent really is companies that have beat on the earnings front have then actually gone on to underperform, which shows me that expectations were already really high. And you're also seeing, conversely, companies that miss some of those high-flying names. I'm thinking of like the Trade Desk yesterday reported essentially 4 years of returns were vaporized in the minutes following the earnings report, and it's now back to underperforming the S&P 500. So those high flyers that miss ultimately are getting decimated, and those high flyers that beat are barely being rewarded. So expectations still obviously very rosy into the future, but of course our companies are growing into those valuations, and multiples are therefore declining based on higher earnings, which is ultimately what we as long-term investors want to see.
So the Federal Reserve, the chairman of the Federal Reserve, Jerome Powell, has a very difficult task ahead of him and everybody in the Fed in 2025, in that they don't want to repeat the mistakes that were made in the 70s, where inflation came back and then they had to put us in a recession. They're going to have to walk this tightrope of the market wanting rates to go lower, but really the economic data saying that they can't have rates go lower. And so stocks can do fine where interest rates are now. Like, everybody who's married to this zero interest rate policy that we had for so long. But remember, in the late 90s when Bill Clinton was president, rates were actually a little bit higher than where they are now, and stocks did fine. So we're okay with stocks doing okay with the higher interest rates. It's the inflation, if it does come back, that's what we would be worried about. So as always, if you have questions about your account or your situation, give us a call at the office, 800-743-0988. We'll see you back here in a couple weeks.